Hey everybody, thanks for joining us today. I am sitting down with Mr. Jake MacCrae from Cross Country Mortgage, and we're going to learn a little bit about the mortgage process. So Jake, tell me a little bit about your background and your business.
So I've been in the mortgage industry now for a little over 10 years. Started out as a processor and now I've become the branch manager of the Cross Country branch here in Indian River County. We are a residential lender. We also own a commercial brokerage as well here in town. So we do everything from your first-time home buyer buying their first home, all the way to a business owner buying their own property.
One-stop shop.
One-stop shop.
Right. So what do you think the biggest misconception that people have about the mortgage and mortgage process?
I think the biggest misconception that most people, especially first-time home buyers, is how to start or when to start. So you have a lot of people that think, let me go find the property first, and then I'll come and figure out the financing, the mortgage after that, which it's really the complete opposite. Really, we like to talk to people probably at that 6 to 9 month mark out before they're really ready to purchase. That way financially we can get them structured to be ready, whether it's their credit, whether it's their savings, so that when they're ready to pick that property, they're ready to go. There's no more say, hey, I don't know if this is going to work or not. No, we know this is going to go through and that the closing is going to go smooth.
And I know as an agent that there's nothing more frustrating than somebody going and looking at properties that are $1 million or $500,000 and they haven't gotten qualified for anything, and when that qualification comes back, we're looking at $300,000. So that's really good to set your expectations ahead of time. And it's an emotional roller coaster. If they go out there and fall in love with all that and then find out that they can't, afford that price bracket, that kind of really takes the wind out of their sail.
Well, it's making that dream become a reality. It's great. You want to think that, hey, I'm going to go buy the $600,000-$700,000 house because I make, $100,000. But at the end of the day, you might have so much debt that your $100,000 went down to $40,000 of what you really have purchase power income wise.
Right.
And I think that's another misconception. People don't realize that, it's great that you make $100,000, but the amount of debt that you carry on your credit can make it look like, hey, I only actually make $40,000 net free.
Yeah. Well, and that leads us, to my next question. How does interest rates play in someone's purchasing power?
The biggest thing when it comes to that, obviously, if you're going from a 3% rate to a 7% rate, obviously that's going to dramatically impact your purchase power. But kind of the calculation you can do is for, let's say right now average rate for a conventional mortgage is in between like 6.5 to 6.75. For every $10,000 to $15,000, it's usually going to be about $40 to $50 monthly is what it comes out to be, especially when you get over that $350,000, $400,000 mark. Now, the lower you go, the smaller that difference is going to be, but the higher you go, the more it's going to be. So, the higher the purchase price, the more it's going to make a difference. On the lower end, the difference between 6.5 to 6.75 isn't going to really make a difference. And what we tell people, especially during the planning process, is that what do you want your monthly payment to be? Like if you're coming from a renter, being a renter, hey, I can afford $2,500 a month, or I can afford $3,000 a month. You should kind of come into buying a property kind of the same way. Like, I know I want my monthly nut to be this, X and Y. But most people don't understand or take into account that, what are my taxes going to be? What are my insurance going to be? What's the HOA on the, on the property? So those are all things that you got to are part of the planning process, really. People think that, hey, I'm paying my mortgage, my P&I, my principal and interest, and that's all I need to worry about. Well, your taxes might be $400 a month. Your insurance might be $400 a month. You might have an HOA of $1,000. I mean, it just all depends on the property, right?
Yeah. Going from that renter to that purchasing, that process, there are those extra, mechanisms, including, am I going to have to replace this AC? Because right now we call the landlord.
Oh, yeah.
And as an owner, you got to kind of look at that, and that's one of the things that I do when I take somebody out is I'm looking for all the reasons why you should not buy this house, and they look for all the reasons why they love it.
Right.
So let's talk about what the changes that you've seen over the past year, and where do you see mortgage rates and the market kind of going in the future?
So as far as the mortgage market, when you speak specifically to rates, the last year and really the last 3 years have been kind of a struggle. They've really kind of been at that 7% threshold. And if you look over the course of a 30-year to 40-year time frame, that's been kind of the average. It's dead set middle. Like back of the 1980s, you were 18-20% for a mortgage.
Yeah.
During COVID, we were down from, I think the lowest I've ever seen was 1.9, and then average was about 3.5.
Right.
So if you take the average of from 1980 all the way to now, we've been really sitting in the middle. But for most people, they think it's very high, but it's also really because the cost of real estate has gone that much higher. I mean, 5 years ago, you could buy on average a 3-bed, 2-bath here at Vero for probably $180,000 to $250,000. That $250,000 property now is $500,000.
Yeah.
So 7% for a property at $250 is a lot different from 7% on a property that's $500.
Right.
The good news is we did just recently get a Fed rate cut, and I'll kind of speak to the misconception of what Fed rate cuts actually do. So Federal Reserve rate cuts don't typically directly impact mortgage rates. What they do is it basically allows banks to borrow money at a cheaper rate than actually, basically gets pushed down to the end consumer. So typically when Fed rates go down, you'll see a couple different mechanisms will move. So the 10-year Treasury bond is typically, when you see that go down, which right now I think we're still hovering over 4% as of today. When you see that go down, you see Federal Interest Rate Reserve go down, you see the UMBS 30-year, which is really where the average rate for a bank or a lender is going to be. Those all three are three levers. Once they are all going down, you see rates to go down. In September, they gave us a quarter or a 25 basis point cut on the Fed, which what the bond market then does is they actually price all the decrease before that, and then once that Fed rate actually happens, rates actually go up, which people are like, well, why would that make sense?
Right.
So what the bond market actually does, and the bond market's what controls all mortgage rates, so that's really where it's derived from. They'll sell off all of their, they'll sell off their bonds, and it'll actually push up the price and the rate. So typically after a Fed rate cut, we'll go down, then we'll go up, and then slowly we'll trickle back down to where that down was for the rate cut. So I think, what was that, 2 weeks ago we had the Fed rate cut. We're now getting closer to the point where it was, 2 or 3 days prior to that rate cut.
Right.
So where a month ago average rate for a 30-year conventional mortgage was right around like 7.25. Now we're at like 6.5 to 6.75.
And do you see any of that starting to pull back? We got another meeting, November 1st is the next Fed meeting?
Yeah, well, they have one every month. They've said that, it's possible that we could get another one here in November, or another one before the end of the year. If we do, you'll probably see a slight decline. I think the massive move that everybody's been projecting for really the last 3 years, in my opinion, like everybody's like, well, just wait until next year. They're going to drop a point. Right. Or, that was 2023. And then it's, wait. We're going to drop 2 points in 2024. Never happened. Right. 2025, well, this is going to be the best year. This is going to be like what it was during COVID. Never happened. The only benchmark you can really put out there, and this is kind of my personal opinion, is the Federal Reserve President, Mr. Powell, is going to go out of office here in May. So there'll be a new Fed president that will come in at that time. At that time, either we're going to see a big cut, which the cuts, the way they work, the Fed, all the Fed chairs basically have to agree on a cut. Right. They have to have a majority vote. So if they do go down, it's still not going to be like, hey, we're going to do a point Federal Reserve cut right then and there. That would shock the market, and it'd be kind of the same scenario we just talked about. You'd see probably a really big decrease again, but there'd be a huge sell-off and rates would go like this.
Right.
But I think you'll see more rate cuts, because whoever's probably going to come in as the Fed chair is probably going to be somebody that's more accommodating to the White House, and the White House wants to cut rates.
I hadn't heard that.
Yeah, right? And I think you'll see rate cuts come out. And I think if they're smart, they'll keep doing them at these quarter or 25 basis point hits. Right. If you do too much at one time, it shocks the bond market too much. And again, you'll have these big ups and big downs.
Right. Current events. Mm-hmm. With the shutdown, how is that affecting what's going on? Should people continue their path? What do you see it affecting? I know FHA and VA loans may, they need to be signed off by, departments that may be closed right now. What would be your advice to somebody who's sitting there kind of freaking out? They're like, oh, I got a FHA loan and I don't know, maybe I just stop shopping. What would you say to them?
So the way that works is there's a pool of money that basically, so Ginnie Mae is the GSE that basically controls VA and FHA programs. Once that pool of money is basically done, the Ginnie Mae will no longer buy from a lender like me, like Cross Country, or a bank that is selling their loans to on the secondary market to Ginnie Mae. The one that, and it's a client that you and I have together here, SBA, so Small Business Loan Association, those basically, it's a little bit different. They basically cut that off completely because that is a completely government-run funding program to where a bank will lend half and then SBA will lend half on a deal. So right now that is completely shut off. So they have to basically have the government turned back on, and then they're going to probably have a stack of files yay high, and they're going to have to work through those files. So like when COVID happened, the IRS basically shut down. I mean, think about how long it took for tax returns to get filed. Yeah. It'll be a similar situation. But the one that I don't think a lot of people are talking about is, and it's more for Florida, for flood insurance. Flood insurance is basically funded by FEMA. They're in a similar situation where there's a pool of money that is used to basically fund these insurance policies, and that will run out quicker than probably any of the other ones. So if you're in a deal right now or your contract and you got to get flood policy, I would recommend you getting it ASAP, immediately, yesterday. Yeah. Because that will eventually run out, and then you will not be able to get flood insurance. Probably some protocols for that, but from what I'm being told, that once that funding's cut, you cannot get funding for flood insurance from FEMA anymore.
Okay. So as people are going through this process, what are the qualities of a mortgage loan officer or banker? What should they be looking for? What's the difference between a good one and a great one?
So there's, just to give you a broad spectrum, there's two categories I put loan officers in. There's transactional and there's planners. So your planner is really what we do as a branch and as a company, where I want to talk to you 3, 6, 9 months before, when you start to kind of get your first conceptions that you want to go purchase a house, or your first time home buyer and you don't understand the process. That way we can get you ready again, so that when it comes time to put that contract in and you have a pre-approval, that you know exactly what you're in for. Usually the biggest purchase you're going to make in your life, as a family or as a single individual. So to have a peace of mind going in it, I know how this process works. I know the benchmarks that I need to hit, and that I know that I'm going to close, rather than transactionally say, hey, I don't need to plan. I got 50 grand in savings. I have a 720 credit score. I'm just going to go put a contract in on a property, and I'm going to go forward, and then I'm going to figure out the financing later. And maybe you're self-employed, and maybe a loan officer gets your tax returns and be like, hey, you said you made 150 grand last year, but on your taxes you wrote off 120 of it, so your income's only 30 grand. Right. And I'd say that's like another misconception that a lot of people, especially self-employed, or if you're 1099, about how much you write off on your taxes, about what your qualification of income can be. Yeah. So my advice really is to talk to somebody at least 3 months out, if not 6 months out, to get your affairs in order. And if you're self-employed and you're looking to purchase a property, or maybe you're looking to build an investment portfolio, get your financial situation and your taxes in order to where you're not writing off your entire income. I see it with restaurant employees a lot, whether you're a server, bartender, hey, I don't claim any of my tips. I'm like, well, is that where you get most of your income? Well, yeah. Well, then you're going to be in trouble. Right. If you're writing everything off and you're not claiming it, you're not showing income that can be qualified at that point. And that's, I deal with it a lot here in Vero. You get a lot of people that are in the restaurant business or in the resort business that, hey, I take everything home in cash and I don't claim any of it. That way I don't have to pay taxes. I'm like, well, then whatever your hourly, whatever you show on your tax return, or whatever you show on your W-2, your year-end pay stub, that is what you're going to qualify income off of. Now, there's other ways to get financing, but if you go and look at, let's just say Wells Fargo or U.S. Bank, you go look on their website and see what those rates are. Those rates are based on you qualifying based on tax returns and W-2s. Right. If you can't qualify based on those, there's other ways to do it, whether it's bank statement loans, asset depletion loans, P&L based loans, 1099 loans, your rates are typically going to be 1.5% to 2% higher than what that rate that you're seeing is on Wells Fargo's website.
And their down payment, or that initial payment is much higher too. As I've heard, maybe 20% that you have to come up with. If you're doing just like a bank statement loan. So they want to see some skin in the game, I would imagine.
Yeah, they're going to want you to bring a little bit more to the table. I'd say typically, like bank statement loans, I see typically around between 10 and 15%. Like for us, it's 10% to bring down. The more you bring to the table, the better that rate's going to be too. And when you're starting off high, the better, and the more you can knock it down to where the conventional rates, the better you're going to be, right?
Right.
But yeah, I mean, there's even loans out there called no ratio loans, and literally what they are is you bring 20% to 25% down, and they qualify you based on credit, literally just your credit.
Yeah.
But your rate's going to be in the 9s, and that's you got to get into a place, that's the options that you have.
Yeah. How are those easy to refi when you get into a kind of a bad loan because you feel like you just need to make that move right now? Is it any more difficult to refinance a qualification like that, or is it once the loan is the loan, then you're okay?
If it's a primary purchase, it's easy to refi, as long as you, like, let's say you get into one of those no ratio loans and you want to get into a conventional product. You need to set yourself up for success with your tax returns and your income. Like I see it a lot with again, self-employed folks that are filing Schedule C's or 1120s, where hey, I want to get set up to take on a conventional loan rather than a no ratio. And I'm like, all right, well, over the next 2 years, you're going to need to structure it that way, and you need to, basically not claim so many expenses or deductions off your tax return. So it's not hard. The ones that really come into play is when you have prepayment penalties, and those are really only on investment properties. So let's say, you can't do a no ratio for an investment property. They don't let you do that. But if let's say you wanted to, you had to get into this loan, and you're like, I'm trying to bring this as least as I can. Like typically the lowest prepayment penalty you can get is a year, and then you're going to get the highest rate you can possibly get in that program. But there's typically a 1, a 2, a 3, a 4, and a 5. And the way they're structured is, if it's the one that you see the most is the 3-year prepayment penalty. So when you have those, it's first year you pay 3% basically back if you're going to refinance or you sell the property. Second year you pay 2%, third year you pay 1%. So it's basically like a declining percentage that you pay out. Those are the only ones I really see that become like, hey, I got to plan this correctly, more time-wise than financially. But if it's a primary purchase and it's your primary residence, it's pretty easy to refi. Usually it's between 6 and 12 months when they'll let you get out of those loans.
Indian River, we're both dads. We got kids go to the same school. What's your favorite thing about Indian River County? Just not from a mortgage and a realtor kind of standpoint, but just as a person that lives here. What's your favorite thing?
I mean, I'd have to say probably our beaches. I mean, you go up and down the coastline from Jacksonville all the way down to Miami. I mean, the amount of clean beach that you have here in Indian River County is probably second to none. And then, if you're a surfer, we probably have one of the better breaks in, not Indian River County, but just right over the border down in Fort Pierce, I'd say is probably one of the better breaks here in Florida.
Yeah.
My favorite too. Yeah. And then of course you always have up in Sebastian there too, but I'd say our beaches are probably second to none here in Florida.
Yeah, I spent a lot of time in St. Augustine, and it's pretty much surfing and chocolate milk.
Yeah. Yeah, and the wave height not very high.
Well, it was a good kept secret. So there was a lot of good surf.
Flagler's got good surf up there too. Yeah.
They do. They just they don't tell you, and anybody escapes. We have to sign something that says we don't tell people. So
right.
I'll have that deleted off there later. Well, I want to thank you so much for having this conversation with me today, and let's get that information out to the people so that they can make the best decisions for them and get them across the line. And if you guys are looking for any kind of mortgage help, I would say see Jake MacCrae. Find him about anywhere online, Cross Country Mortgage.
Yep.
All right. So thanks again for being here.
All right. Thanks, Jeff.
Yeah.